Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about NextDecade. They just recently achieved their Train 5 FID, so I'm trying to give an update here. Um, and I will be talking through an updated valuation model and going through some highlights on their investor presentation. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in NextDecade, so this video should be for your entertainment purposes only because I can be wrong about everything that I say in this video. You need to do your own research before making any investment decisions. I see there's already some folks in the chat, so thanks for showing up. I do read all the chat messages and try to respond to you in real time. I'm still small enough to be able to do that, so I appreciate everybody who's here. And like I said, I'm going to be talking through this NextDecade Train 5 FID and some investor highlights. So this is a big deal. You know, I've been investing in the stock since slightly before they got approval from FERC to actually, export LNG, and this is a big milestone because they're finally capping off, the fifth train of this facility, and so it's a big deal. Now, and I guess I should mention, y'all are investors. The stock was really unimpressed, right? I think this is a big it is a big achievement for them, but you look at the stock chart and you really wouldn't know, right? They're kind of where they were years ago. They were probably at these levels about the point when they got, if I go to the all-time stock chart here, and this is only going to be real quick, they were back at the $6 level in pre-COVID in 2019, right? Probably my first shares that I bought were in the $5, $6 range. So I've been flat on this for quite a while. I have certainly added since then and at various prices, but you look at this chart and you see this big drop off recently as they've had these most recent Train 4 and Train 5 FIDs. And I talked about this after Train 4, so I'm not going to repeat myself on all of that. But it is a little bit interesting to me that they got the Train 5 FID, still not a whole lot of additional dilution. There's a tiny bit which I'll talk about. But not a whole lot of additional dilution, so no real surprises after the Train 4 FID. They got Train 5 very quickly afterwards, quicker than what I expected, and stock's still down. And I'm going to go through my valuation model today, but I personally think that the stock is undervalued at this point. Again, not financial advice. I'm not going to tell you what to do, but I personally have been buying, plan to continue to buy at these levels. Under $7. Personally, I'm going to continue buying for as long as it sits there, unless something material changes. So just right off the bat, and I mean, if you just want the punchline, you don't want to go through me talking for the next 30 minutes to get to all the details and assumptions behind this. I think with some pretty reasonable assumptions, I can make the case that the stock should be worth $9 to $10 today. And that's, again, not financial advice. I could be totally wrong, but that's kind of how I view it. And I've got a lot of a model that backs that up, and I'm going to go through it in a little bit. But before that point, let's talk through some of these details here for the company. And as I mentioned, they did achieve their FID here of Train 5. And if we go through this investor presentation, they have some details here where, hey, they finally gave us full production volume projections for the facility, which is not new. Their full EBITDA projection, which is not new. We got that after the Train 4. But I mean, this is just good to see it all reaffirmed here. It's good to see that they have Phase 1 construction still on track, right? That's I haven't talked about it on this channel for a very, very long time, but they have Bechtel as their contractor, and they talk about this a little bit in their investor call. If you're invested in NextDecade or considering it, they just recently on I guess it was Friday, I think Friday or Thursday, the day after the Train 5 FID was achieved, they had an investor call where they went over this presentation. The CEO did, Matthew Schatzman, if I recall correctly, his name, went over this presentation and then answered some questions from analysts, and that had some good nuggets in it. But they mentioned this there, that they're still on track, and they have Bechtel as sort of a top-notch, high-quality contractor, and they really expect this to get done on time, and I do as well, based on everything that we know today. I think that's a reasonable assumption, right? It's not optimistic. It's not necessarily, I think you could be pessimistic and have worse assumptions. I think you could be optimistic and say, well, it could be done even early, and that is a possibility. But Bechtel has a pretty good track record, I guess, is the point. They've built a lot of LNG plants. And another thing that they highlighted there, which doesn't really build into any model, but it does give you more confidence that they are going to deliver these trains on time as projected, is that because NextDecade has actually gotten to the point where they have all 5 trains FID'd, they're sort of stair-stepped in terms of delivery dates. Bechtel can kind of shift their workforce from one train to the next one to the next one, sort of in phases as the work progresses. So I have a question in the chat already. Vaseline Ball asks, if Next is worth $9 to $10 now, what do you value it in 5 years? So I think in 5 years, it's probably that is with I think right now I'm using a 13% nominal discount rate on all future cash flows, and so I think in 5 years it's probably in the $15 to $20 range. And again, I will get to my valuation model, so because there are a fair bit of assumptions baked into that, but that's not that I think it's maybe fair value is $9 to $10 today, and then in 5 and then it grows 3% per year after that, right? That's actually would be a 13% CAGR, I guess, or a 13% discount rate on those cash flows. Maybe it's not necessarily a CAGR specifically on that. I have to think through how the math works, but I think in 5 years it's probably a $15 to $20 in intrinsic value. I could actually run that calculation when I get to the model if you want, and I will try to remember that when I get to it. So anyways, talking through a little more of the investor. Good question. Thank you for asking that, and I will, like I said, I will try to model that when I get to the actual numbers here. Real quick, I'm going to go through. This is not news to anybody who's been following the company, but they did talk about the actual sales and purchase agreements for LNG that they have against Train 5, and they have about 75% of the capacity for Train 5 contracted. And they still didn't directly disclose the tolling fees they have on this. I think they are all linked to Henry Hub, so that's good. And presumably they have the 115% of Henry Hub price built into that, so that they have some additional wiggle room there for the LNG transport, and just in case their cost of gas is slightly high. Although, again, they actually talked about this in the call, and that's a nice nugget that I think they have later on this investor presentation, where they expect to be able to purchase the gas lower than Henry Hub because of their particular location where they are in South Texas. But the implication of this is also that 25% of the capacity is uncontracted, and they do expect to be able to sell that at higher margins, right? Higher spread between the gas that they're purchasing and then the LNG that they are selling, than what they're actually higher than what they're getting under these contracts, right? And these contracts do have a lower margin because those buyers are signing up to purchase it for 20 years, and those are take or pay contracts, to my knowledge. So those buyers are going to pay them even if they don't need the LNG and don't want the LNG. They're still going to pay them, month after month or quarter after quarter, however it actually works out, to actually for that capacity of being able to purchase the LNG even if they don't want it. So that is the general structure. Shouldn't be news to you if you've been following the stock for a while, but maybe it is if you're newer to the company. I'm going to note this real quick as I move on, and I'll come back to it later. But they do have expansion capacity, right? And I said when I first opened the stream that Train 5 represents sort of the end of what they're currently approved and permitted for at the Rio Grande LNG facility. They've talked about being able to expand right there at the site, right? And Train 6, I think I mentioned this in my last video, but Train 6, if you can see it, exists within the space that they already have at the site, right? So presumably they've already, cleared this land or leveled the land and have this kind of prepared in a way that those areas to the left and to the right of their existing developed site aren't necessarily ready. And that is partially because the original, as far as I understand, the original design for this facility was a 6-train design, and they were able to do some design improvements and to say, hey, we can actually produce and export the amount of LNG that we wanted to with this first facility in 5 trains instead of 6. But the space is still there for the 6th train. I guess their plans for the actual site didn't change. They just said, hey, we don't need to build the 6th train there. And so it is interesting that they have that right there. And I would guess in terms of $1 per dollar per MMBTU basis, right? Train 6 is probably going to be significantly lower than 7, 8, and then 9 and 10 as they are talking through these expansions, because it is within the existing space that they've kind of set up, let's say, or done some initial infrastructure work on. But they do have space here, they say clearly, for trains 6, 7, and 8. And then they hinted at maybe even also trains 9 and 10, but they're being much more concrete on trains 6, 7, and 8. So that is nice to know that they have this expansion this space for expansion right there at the site. They don't have to go acquire new land, find a site, because there actually aren't that many places. There aren't that many sites, as far as I understand. And again, I'm not in the industry, so maybe I could be totally off base here. But as far as I understand it, there just aren't that many places along the coast where they have good access to gas and good access to shipping, in order to be able to have ships come in and out to get the LNG, that just make good sites for LNG export facilities. Sorry to see another question coming in the chat. Contra 100 says, thanks for following up on the Train 5 FID. Can you share your model same as last time? Yes, I will. I will do that immediately after this video. Sorry, I'm so bad about doing that beforehand. I will add a link to my spreadsheet immediately after I am done with this stream. I would do it right now, but it would take me a couple minutes to just be wasting your guys' time while we're live. So I will do it right afterwards. Thanks for reminding me. So, all right, moving on. I do want to go down a little bit to this slide, right? And this slide does talk to why, a big part of, I think, the thesis for a lot of people as to why the stock is down is because of the assumptions that were put into the guidance, right? I'm going to go through the guidance in, through this video in terms of what the company is projecting for future cash flows and, EBITDA, etc. But a big factor for the company is on those uncontracted volumes, what profits do they make, right? Because we can look at the contracts and we can say, well, for your contracted volumes, we have an average tolling fee of, let's say, $2.50 per MMBTU. Who knows what it's going to be for the uncontracted volumes, right? You can look at futures, and I've done that in the past, and maybe I would do that in a future video if folks are interested. But if you don't really know, right? Predicting commodity prices a year, 2 years in the future is hard. Predicting it 5 years in the future and 10 years is, ridiculously hard, right? Nobody really knows what it's going to be, and there's so many events that could happen that could push that up or down. There's a lot of talk, a lot of chatter online about maybe having some sort of an LNG supply glut in the a couple years out, and so that might hint towards prices coming down. On the flip side, you might have world events, let's say, wars basically, or other political events that impact the energy industry. And the LNG industry is still not quite as liquid and decentralized as the oil industry. And so, if certain parties lose access to LNG from certain places, or even just natural gas, it doesn't have to be LNG, it could actually losing access to natural gas if they get through pipelines, in which case they might need to replace that demand with LNG. Those sorts of displacements in the market can have a humongous impact on the price of LNG. So that guidance, or that assumption that NextDecade is making when they guide out their cash flows, they are assuming a $5 spread between the gas that they are selling and the LNG that they are selling versus the natural gas that they're purchasing. And again, that's actually their LNG price, right? They're just using JKM right here, minus the cost of them purchasing the gas and minus the cost of shipping the gas, right? And I think there's in the footnote here, they're assuming $2 per MMBTU for shipping cost, and I think that's pretty reasonable. But the whole point that they have with this slide is they're saying, hey, historically, if we're looking at where the margin actually was in the past, over the past 14 years, from 2011 all the way through to 2025, it's been at or above the guidance that we gave for most of that time. There were periods where it went under. I still think it's a little bit hard to really compare some of these periods because the LNG market was just really small. But then again, you can argue maybe that cuts both ways, right? In the sense that the market now is is larger and more liquid, and maybe there's more entrants who are going to come in, and you will see the supply go. Who knows, right? And if I was being critical and skeptical, and I wanted to be pessimistic about the future, I would say the most recent point is, yes, it's technically above the orange line, but it's heading down towards it, right? And so maybe in the near future we will actually see this come down and come down below that guidance of $5 per MMBTU. And it is definitely a risk, right? I think this is one of the largest risks to the valuation of the company, right? Is just that the LNG commodity prices versus the gas prices they're purchasing at are just not very favorable. And so in the future they might just not make that much of a profit on those uncontracted volumes, and that has a pretty big impact, a humongous impact on their future cash flows. And I'll talk through that when I get to the model, or when we start talking about train by train some of the stuff. One of the things on the flip side that they did highlight in this call is they basically said, one thing not to forget that is an advantage that Rio Grande has, that NextDecade has, that other facilities don't, is that they purchase gas generally structurally at a lower price than Henry Hub, because they are not actually purchasing it at Henry Hub. They're purchasing it at in South Texas, and they say usually our gas is like 30 cents cheaper, right? They expect South Texas natural gas to price at a discount to Henry Hub, right? So that gives them some spread already built in, even though their contracts are indexed to Henry Hub, because that's basically the industry standard right now for U.S. Gulf Coast LNG. So just one thing I wanted to call out, and they highlighted that in the investor call that they did, and I thought that was a really good nugget. All right, so real quick about the Train 5 funding before I get to the valuation model. This was a total of $6.66 billion for the project, and this I think is about 60% debt. If I do the math here, about 40% equity. I guess I could do the math real quick for you to get the actual numbers. 2.57 divided by 6.66 is 38.6% equity, so the remaining, so it is about 60-40 debt to equity that they use for the funding of this facility. And NextDecade put in half of the equity. So if you look at the equity split, it is 50% NextDecade, 50% their partners. If you notice, this is slightly different than Train 4 because Total had an option to purchase 10% of Train 4 and Train 5. They exercised it for Train 4, not for Train 5. And so NextDecade came up with the additional 10% themselves. And so they put in that money, and sort of they talk it through here where they use some cash they already had on the balance sheet, although technically on the balance sheet is a little bit strange, since some of this was actually cash that they got from the close, because they received at the close of Train 5 because they had already done some development costs. Basically got credit for that. Kind of weird wording here, but the point is they did take on additional debt for that remainder, other than the $233 million. With this is very similar to Train 4. They have a FinCo loan and the Super FinCo loan, as they call it. And these are term loans with different interest rates. Some is variable, some is fixed. Both, I believe, payable in kind. Sorry, this one's payable in kind. Is this one not payable in kind? Maybe I'm misremembering that. Sorry, there's a lot of details here. But the point is that they have these two loans, and that is how, sorry, these are loans, and I think they have a diagram for this. These are loans that they took on basically above the Rio Grande structure, right? So this is NextDecade, and down in the Rio Grande project, right, they have some of these loans that they've actually termed out for the project. I guess that's for the phase 1. For the phase 2, they have the project level debt here and here, but then that debt, the FinCo and the Super FinCo, are at these levels. And basically the point here is that this is kind of like debt that is at the NextDecade Corporation level, but not at the Rio Grande level, right? Because this is how NextDecade borrowed money in order to have the cash, in order to say, hey, we have equity in Rio Grande, in the facility here. And so there are, different. I should stop saying there are different levels of debt. Debt at the NextDecade level, and then debt down at the Rio Grande project level. And there are different slices for Rio Grande Phase 1 versus Train 4 and Train 5. So it is a little bit complicated, but luckily the company has their projections on how they think things are going to shake out in terms of their cash flows. Before I go to that, I do want to mention real quick, they gave good guidance here on, I don't know what it's doing, extracting text from PDF. Hopefully that doesn't mess my stream up. But they gave guidance here on their commissioning cargoes. And this is actually a big deal, right? So if you have also seen my videos talking about Venture Global or familiar with Venture Global, Venture Global is, sort of infamous for having a whole bunch of commissioning cargoes at their facilities. And commissioning cargoes are cargoes that the facility, as it is still being constructed and built and hasn't yet sort of been declared complete, it does produce some LNG during their actual testing, right? The commissioning phase. They're testing out the facility, and that LNG has to go somewhere, right? So they produce it. They don't just let it sit there. They don't have storage here. I mean, they have a little bit, but they're generally not just going to store it up until they have the facility completely ready to go and start serving, giving LNG to their customers on a regular basis with the throughput that they guarantee or that they're selling at. And so these commissioning cargoes, they are still they're the property, I guess you'd call it, of Rio Grande, and they're not necessarily, they are uncontracted volumes. They don't belong to the customers that have signed these long-term sales and purchase agreements. And so NextDecade gave us guidance right here on how much LNG do they expect to produce during those commissioning phases. And so you can see right here, during those commissioning phases, they expect to produce 1,275 trillion BTUs of worth of LNG. And we can convert that into how much revenue do we think that would be for the company. Now this goes into my model. And I did some math to figure out how much do we think that is on a per train basis, right? Because these orange bars that are the uncontracted volumes, this is the sum. This is the combination of both the commissioning cargoes from the plants and also the uncontracted volumes from the trains that are post date of first commercial delivery, but that do have some portion of uncontracted volumes. And what I mean by that is all the way up until Train 3, Phase 1, meaning Trains 1, 2, and 3, once they hit their date of first commercial delivery, all of those sales and purchase agreements will go into effect. And so the LNG that is being produced from Trains 1 through 3, 93% of it will be going to customers under those sales and purchase agreements that, those 20-year sales and purchase agreements, 15 to 20 years, whatever each individual one is. But that has a fixed fee the NextDecade will be, or that Rio Grande will be receiving. The last 7% is still uncontracted. So even once Trains 1 and 3 are up and running, the vast majority of that capacity will go to customers who sign contracts, but not all of it. And so there is a little bit remaining that during the time frame when they're still constructing Train 4 and still constructing Train 5 and getting them to their point where they hit the first commercial delivery date, Trains 1 through 3 will still have a small bit of their capacity that is uncontracted. So if you take both the commissioning cargoes from each one of these trains and those uncontracted volumes from the trains, just the amount that is uncontracted, all the way up through to the date of when Train 5 hits its first commercial delivery, that is what this orange bar here represents. And so that is a significant amount of gas because they can sell that at higher rates than what the contracted rates are for those long-term sales and purchase agreements. And that actually makes a pretty significant difference in terms of recouping their volume. Now, I will say the volumes are not nearly as high as somebody like Venture Global, because Venture Global gets a portion of their facility online very, very early on in the time frame. In terms of how long it takes to build these facilities. So that is just, it was good to see the guidance here so that we can start to model this out. And the company has also given us some pretty good guidance in terms of their finances. And this is I think the last slide I'm going to talk through before I go to my actual model here. For the company, they break the world into basically 3 time periods for their facility. The first portion of the time period, the first time period is between now and when Train 5 hits its date of first commercial delivery. And that's the point at which all the sales and purchase agreements for Train 5 go into effect, and then there are earlier dates for Trains 1 through 4. But on that date, all of Trains 1 through 5 will now finally be under their sales and purchase agreements that are these 15 or 20-year agreements. And so you can start to model this out and say, okay, what sorts of, revenue, EBITDA, distributable cash flow do we expect during that time period once we actually have all those trains up and running and the sales and purchase agreements are all in effect. So that is sort of the second time period that they start here, and they talk about that as the post date of first commercial delivery date for Trains 1 through 5. And then there's a later point in time that they say sometime in mid-2030s, and I'm going to talk about this in a moment, when their equity interest in Trains 4 and Trains 5 will increase by 20%, or I should say 2,000 basis points. It will increase for Train 4 from 40% to 60%, for Train 5 from 50% to 70%. And I will admit, if you've watched my older videos, like the Train 1 FID, Phase 1 FID projections, I did not quite understand exactly how this pre-flip and post-flip modeling was going to work, and I think I have a better understanding of it now. The company still hasn't disclosed the specifics on this, so I have a model here, but even this model could still be wrong. It is much more, I think much more accurate than my prior understanding, but the company still hasn't disclosed the exact hurdle rate that that their equity partners are requiring before those equity partners are going to basically transfer over some equity ownership from themselves to NextDecade. But the point is, there is some point in the future where, as long as those equity partners reach a certain return on their original investment, then they are willing to say, okay, now in the future, NextDecade, you guys can have an even higher portion of the equity in Trains 4 and 5. And at that point, that's when they call it flipping. And after this flip occurs, NextDecade's cash flows, right, their share of the Rio Grande cash flows will increase slightly in Train 4 and Train 5, and so that will actually increase the distributable cash flow for NextDecade at that point in time. So if you just look at the company's projections, they say, starting in the middle of 2031, they expect to have $500 million per year in distributable cash flow. After that flip, again, they say in the, quote, mid-2030s, they expect to have about $800 million per year of distributable cash flow. And they give some more details here in terms of their, EBITDA, how much they expect to have for project level interest, etc. And so you can look through all this. I certainly have in some detail. And then that gets me to the model that I have. So let me get to this point and explain what I've got here. I will try to be as quick as I can, even though I know there's so much in here. It always goes a little slow. So the first portion here, I modeled out quarter. So this is generally a model that goes quarter by quarter. So every column here represents one quarter. Starts in 2027 Q1 and goes all the way into 2048. And I wanted to do that because I wanted to model out 20 years of production, right? So this is the point at which the very first sales and purchase agreement, from Train 1 will start to roll off. Technically, there are some 15-year agreements that will roll off slightly sooner, but the vast majority of the sales and purchase agreements that NextDecade has for the Rio Grande facility are 20-year agreements. So I am modeling out the cash flows under those 20-year agreements, and also the cash flows from the uncontracted volumes that they have over that same 20-year period. So that's my note on the timeline that I've modeled this out here. And so in this model, I'm assuming no cash flows at all past 2048, even though, unless there's some other energy source that makes LNG basically obsolete, it's hard to imagine that they would not be generating any cash flows anymore from this facility, right? I think you can folks that have talked, and they say the newer LNG facilities, they expect to be around for 40 or 50 years, not merely 15 or 20 years. And so this model is undervaluing the company, let's say, because it does not give any consideration to cash flows after the first 20 years from the very first LNG production. All right, so getting all the way back to the beginning, I modeled out every train individually, and I modeled out the contracted and uncontracted volumes for each one, and I assumed that they would ramp up their commissioning cargoes just a bit, where they have 3/4 of commissioning. And the volumes here, excuse me, are 61, 77, and 77 trillion BTUs per quarter. And then after that point, it flips, and then they have contracted and uncontracted. Now, you can notice it's all uncontracted when it's commissioning, as I mentioned before, and then it flips. And for Train 1, I assumed almost all of the capacity was contracted. They actually don't split this out between Trains 1, 2, and 3. They just say that Phase 1, as far as I know, they only say that Phase 1 is about 93% contracted. I assume that there is, nearly all of Train 1, slightly less of Train 2, and then slightly less of Train 3 that's contracted, only because I assume customers wanted their LNG sooner rather than later, right? And Train 1 is going to deliver LNG sooner than Train 2. Train 2 is going to be sooner than Train 3. And so that's why I have things modeled out this way. But you can see, as I go out in time to 2029, it gets to the point where Train 3 is completed, at the end of Q4 of 2028. And then starting in 2029, I assume steady state from Phase 1, where you just have LNG being produced from all three of these trains, spanning all the way out until, the end of 2048. For Train 4, similarly, in Train 5, I put exactly the same volumes for the commissioning phases, and I have Train 4 completing at the very end of 2030 and flipping over into 2031 to the long-term sales and purchase agreements. And for Train 5, commissioning and ramping up all the way through to the end of Q2 2031, and then hitting steady state at the beginning of the second half of 2031, which I think is matching exactly what the company has told us so far. So given all of that, I add up the total contracted and uncontracted volumes that NextDecade will produce in each quarter. I then have a margin of $2.50 per MMBTU for the contracted volumes, just across the board, and then $5 uncontracted across the board. And once again, this goes back to the company's projections. This slide, where was it at? Right here. Right now, I'm just matching the company's guidance. If you think the company's guidance is too high, then you would actually say my model does show that the stock currently should be worth around $9 or $10. And so if you think it should be lower, then that would help explain why the stock is lower and why the market is kind of giving it a lower valuation than what I am looking at here with this particular model. So just something to keep in mind, right? To understand the assumptions that I have baked into this model. But after listening to the company, I do think this is a reasonable assumption, right? I think they have pretty conservative assumptions baked into this in terms of $2 per MMBTU shipping cost and some of these spreads. I think there are reasons why these, why the spread is going to be pretty decent going forward, right? And I think, especially, you just have to put it into context and think people are paying $2.50, and I think nowadays it's gone up even a little bit since then in terms of what folks are signing for long-term contracts. If you're willing to sign up for that over 20 years, is it really that unreasonable to think that people are going to be able to get $5 margin if they're only committing to buying one cargo here, one cargo there, right? So it does, their guidance does make sense to me, and maybe this will end up being too optimistic. Maybe the company won't do as well as what we have here, but that's just so you understand the assumption, what is baked into this model right here. One thing that I did do, well, let me go through just a steady state calculation here, and then I'll talk about a little bit of how I dealt with inflation here. Based on those, you can multiply it out and say, here's the gross profit they got from their contracted volumes and uncontracted volumes, get the total, quote-unquote gross profit. Then I have a model for their operating expenses on a per TCF basis, and I do that only because, in these earlier years in 2027, 2028, not every facility is going to be operating. If Train 5 is still being constructed, they're not paying their operating expenses for operating the facility yet. And so This OPEX does actually ramp up over time, but in the steady state here, it hits to this point, and that gets them to an EBITDA of about $925 million per year in that steady state. Sorry, per quarter, not per year, per quarter. And hopefully that matches, what the slide deck said that the company gave, right? So if I multiply this out, it's around 925 times 4, it gets me to 3.7 billion. If you go back to the company's actual projections, if it will load, yeah, I reverse engineered these numbers so that I do match the company's projections. And so I think that's the best credible estimate we have of operating expenses, what the company is, providing for us. So go back and look at that. And I also use the company's projection for debt service, where they put in, I think, $1.6 billion, at the project level. And that allows us to calculate their distributable cash flow at the Rio Grande level for the overall facility. Then I modeled out each train. I modeled out train 4, train 5, and then, trains 1 through 3 all together. Basically just breaking out some of these portions. And I did this specifically because I wanted to see at what point, sorry, that's extraneous. I wanted to see at what point does the company hit the hurdle rate for the equity investors' equity to actually flip from, for trains 4 or trains 5. And, as a big caveat, the company has not disclosed what is the hurdle rate that these folks expect to get. And I don't think that's been included in any filing. I have poked through a lot of them. Maybe I missed it. If you're aware of it, please let me know. But I'm not quite sure. There is a person online on Twitter. His handle is the LNG investor, I think, maybe LNG_investor. If you just search on Twitter, I'm sure you'll find her. On X, I'm sure you'll find him or her. And that person basically told me, they said, you should model out an 8% hurdle rate, which that sounds pretty reasonable to me. And I modeled that out here, and that's why I'm looking at this in terms of train 4, what is their distributable cash flow, and then what is the partner's portion. And if you discount that back at an 8% rate, what is the cumulative cash flows of the partner, so that we can say what is the point at which they actually hit that total 8% internal rate of return for that investment. And if I model this out, if I go all the way out here, it hits the flip point for train 4 in Q4 of 2038. So that is what I've used in my model here. For train 5, the timing is similar. It actually is slightly better. I don't know exactly why it works out. I didn't look in details of why it works out that way, but flipping happened basically at the end of Q2 of 2038. So they're in the same year, in 2038. And if you look at that, that is interesting, because the company is calling out quote-unquote mid-2030s plus, and you might be a little, I'm not going to say it's misleading. It's certainly a bit optimistic to call it mid-2030s for this flip if, it's actually most likely going to happen in 2038 based on the company's own projected margins. Now, there are certainly some things that could make this happen sooner. Number one, obviously, would be if they do get higher spreads, higher LNG prices on those uncontracted volumes. That could make this significantly sooner. Another thing that might happen here, and then they talk about this a little bit on their call, where they basically said, we do also have a good chunk of money set aside in each of these trains for basically contingencies, right? Cash is set aside in case some of these bad things happen. We've already got the cash to pay for it. And, that's on the order of, I'm going to round it off, about $2 billion for train 4 and about $2 billion for train 5 for owner's costs and contingencies, etc., and some of the paying the interest on the debt, I think. And I don't know exactly how much that is just for certain, various contingency situations, but it is quite possible that, this could be a couple $100 million where if things do go well and they don't have some of these, negative situations arise, then they may be able to return that cash back to the investors quickly, right? Like they may be able to return back to investors within a year or within 2 years, rather than 10 years in the future, where we're looking at some of these cash flows and having to discount them back. I mean, the discount rate gets pretty onerous the longer and longer we have to go out in order to actually achieve this hurdle rate. So that's just something to keep in mind. Those are basically the risks to the upside for this flippening, if you want to call it that. All right, sorry, I have a question in the chat, so let me pause going over the model and say Freedom Pacific says, I just logged on now, so I'm starting at the beginning of the stream, but any insights on the big increase on call options activity? I seem to remember big volumes a couple weeks ago for November/January. If you were seeing the volumes a couple weeks ago, I would speculate, like if I had to come up with an explanation for why were there significant call option activity, I would speculate that people thought NextDecade was going to actually get their Train 5 FID, and they thought that that was going to be a positive catalyst for the stock. Again, I'm looking at this model here, even with, just with these projections, my model basically, and I'm going to get to it in just a second. I guess I could go right down there right now to show you kind of the assumption is that the stock has the intrinsic value around the $9 to $10 $9 to $10 right now. I think it's, the exact model right now gets you $9.89, and I have a couple things more to talk about. But just answering your question, if other folks are modeling this out similar to how I am, and they're seeing a similar intrinsic value, they may have thought that after they, remove the risk of Train 5 not getting FID'd, and that they are at the point where Train 5 is, the construction schedule is known. Again, there are still risks to construction, but at least the planned schedule is known. Although there's no financing risk anymore. That might have been a positive catalyst for the stock to actually realize some of the, close in the gap between where it's trading at today and what folks might be modeling as the intrinsic value per share. That would be my guess. Again, I actually personally don't put too much stock into it because you always have to remember with options, or even with any of these people, people say there are big trades. For every buyer, there's a seller. So if a lot of call options were purchased, that also means a lot of call options were sold. So just personally, I don't read too much into those kinds of transactions. Just my personal observation, because the number of times in which I've seen those things called out is a lot more than the number of times in which there was some hidden secret or piece of information that one party knew that other folks didn't. There are equal buyers and sellers, so it's hard to read too much into it when the volumes increase or decrease for that matter. All right, sorry, just real quick, going to go through the rest of this model and then talk through some of the implications. When I model out the ownership here, I have, again, the 20.8% for trains 1 through 3, 40% for train 5, and 50% for train, 40% for train 4 and 50% for train 5 for now. And then I have it modeling to flip, you can see here, in 2038. This is the year 2038, if you see the very, very first row here. Flips in the exact quarter that I think they're going to flip for train 5 and then train 4. And so going forward, sort of 2039 is your first year where you have the full eventual ownership that NextDecade will have in each of these trains. And so the way that models out when I add up the cash flows is down here. And so I just add up the cash flows from each, trains, oops, I should say train 5, not T4, from trains 1 through 3 and then train 4 and train 5. Add those all up and then subtract off the interest and the G&A expense at the NextDecade level, which I just pulled directly off of the company's guidance here. They're guiding $200 million per year in interest and G&A expense, and so I just, on a quarterly basis, that would be $50 million. And so based on that, I can then finally say, what is the NextDecade distributable cash flow on a quarterly basis? And from there, then I can look at all of those cash flows and I can say, okay, if that's what we expect into the future, discount it back to today at, whatever discount rate we want. I chose 13% here. And again, this is a 13% nominal discount rate. A lot of my models are in real terms. This is in nominal terms. And so if I look at this and I add up all the net present value of those future cash flows, to me that looks like the company, the equity should be worth about $3.5 billion. I divide that out by 350 million shares outstanding. And this is more than what are currently outstanding. Just so we're clear, this is what I modeled. If you look at the current company The current company has, I think, about 262 million shares outstanding. There's some about 14 million shares between restricted stock units and stock options that have already been granted. And then they issued about 15, I think it was 15.5 million shares, potentially 15.5 million shares in terms of convertible debt that they just issued from as part of the Train 5 financing. And that is buried in their 8K. If you look at their 8K right here, this is the one just from a couple days ago. There's something down here about things converting at a $9.50 per share price. Probably a little too small for you to read. Zoom in here. So there is this exchangeable loan is what they called it. These are convertible notes, basically. They should just called it that. At least as far as I understand it. Maybe I'm wrong, but the way I read it is they're just convertible notes, and these can convert in 5 years at a $9.50 per share strike price, basically. And so if you add that up and you look at the size of the loan, I think this is about 15.5 million potential shares to the company. So if you add all those up, it adds up to somewhere around 295 million shares outstanding. I'm also modeling in, because I'm looking long term, I expect between now and some point when they're in a steady state, they're probably going to issue more shares in order to fund the company, fund development on some other train. They're going to give out some stock-based compensation. And so I like to have a slightly higher number. If I looked at only 300 million shares outstanding, which is roughly where they're at right now if you convert everything, all the stock options, all that exchangeable loan, it does increase the share price, the current intrinsic value per share, up to about $11.53. But I think it's, personally, if I'm looking out 20 years in the future for some of these cash flows, I also like to look out a little bit. If I'm planning on holding in order to realize that value, I also want to look out in terms of a little bit of, if they were just targeting these operations for trains 1 through 5, what do I think is kind of close to a terminal share count? And that's where I put this at the 350 million shares outstanding. You may totally disagree with this, and I know this is like maybe a overly pessimistic assumption, but that's how I like to model things. And so based on that assumption, everything I've said so far, this is how I derive this $9.89 intrinsic value per share calculation. And as I mentioned, that's using a 30% discount rate. If you wanted to give it if you want to look at it and you want to do sort of the inverse DCF and say, what is the market currently discounting the stock at, you would have to put in something, let's see, maybe 18%. So about 18% is the discount rate that the market is currently giving it, based on some of the other assumptions that I have in this spreadsheet. So I think that is way too steep of a discount rate for this company. Now, that is general model. One note that I will call out here is that certain portions of this model, both the margins on their future LNG and the operating expenses and their G&A expenses that I have should be down here in row number 83. I increased all of these starting in 2033. The first year, I think, of full 2032, I guess, the first year of full steady state operations, by 3% year over year, and that continues until the end of this. And that is because, clearly their operating expenses are going to increase over time, right? They're not going to be able to pay people the same rate for 15 years in a row. They're going to have to give them some raises every year in order to match inflation. Same with their actual, their sales and purchase agreement should have this. The price of the LNG, yes, it is a $2.50 fee per now, let's say, when the sales and purchase agreement goes into place and when they have their first commercial delivery of the LNG. But these contracts, to my understanding, and shout out to Chris Patel, another, you can search for him and find him online. This is something he called out for one of my prior models where it was very, very unclear in terms of how I was dealing with this. But this is something that is built into those contracts. Typically, they are indexed to inflation, and so that $2.50 fee that they might have on a per MMBTU basis, that is what it is for the very first cargoes, and then on an annual basis from that point, they will increase that fee, indexed to some inflation index, and I think generally this is CPI, U.S. CPI. Which makes sense. And so for this, again, for this model, I'm just putting in 3% as the steady rate of inflation over time, right? Because the dollar is not going to be worth what it is in 2048, what it's worth today. And so that fee will increase over time. I also did this for the uncontracted margins just because, again, similar reason, the dollar will be slowly losing value over time until you'd expect commodity prices, even if commodity prices stay, at the same, it will increase over time just due to inflation overall. And so that is already accounted for in this model, and you can see if I go all the way out to 2048, their contracted margins go up from $2.50 per MMBTU up to $4.13 per MMBTU, and again, you could expect inflation that should be a pretty conservative number, for inflation. The one benefit that does have is because this is a capex heavy, a capex front loaded project. The debt that they take on does not increase over time, right? That debt is at a fixed interest or a lot. I'm assuming that they're going to be able to refinance all their debt at fixed interest rates. They've started doing that, as they showed here for the trains 1 through 3, right? They've started to refinance a lot of these. They are terming it out all the way out to 2047 to have fixed rate 6.85, 6.58%, etc. And I assume they're going to do the same for all the debt that they have. As they get these things up and running and they can show, hey, we've got this steady cash flows from these long-term contracts, I think they're going to end up getting to be, their bonds are going to get to be graded, BBB or whatever by the ratings agencies. Similar to what Venture Global just went through this process, right? And they now they're able to issue or refinance at, I think was it 5.8% or 5.6% or something? I don't remember off the top of my head, but much lower interest rates because they have these long-term contracts. Their cash flows, at least the base of their cash flows, are very predictable. NextDecade, I expect it's going to get to the same situation, in 5 to 8 years once they have train 5 up and running, trains 1 through 5 up and running, I should say. And for that reason, there is going to be a divergence where the spread that they're getting on their contracts it will steadily increase every year due to inflation. The cost of their debt will be flat, right? And so because of that reason, they will start to make slightly more and more and more cash flows every year. All right. One other thing I wanted to mention here that I do have in this model is, it's not much, but I just put together a nice chart of what does this look like in terms of their distributable cash flow per share every year. And so you can see this is partly why there's such big swings in the stock. Number one is because there's so much assumptions baked into everybody's projections, but number two is because it's really hard to say what are investors willing to pay for it when the cash flows go up and down here, as you see over time, right? This is what my model projects. I think this is pretty close to what the company is projecting. But you have some of these spikes initially where you have commissioning cargoes that actually can give them, higher cash flows. The cash flows on a per train basis do drop immediately after that short commissioning phase because they are not able to get that spread on all the LNG volumes. They're only able to get that higher spread on the small portion that is uncontracted. And then you have this portion, this big step up between 2037 to 2039, and that is the flip, right? This is visually you're seeing here when NextDecade has this guidance and they say, hey, here's the pre-flip cash flows, here's the post-flip cash flows. This big step up from 2037 to 2039, that's the flip. And you do see this sort of steady increase year over year. That's because of the difference between the inflation, where we do expect their margins to slightly go up every year due to inflation, but for the debt cost to remain flat in a nominal basis, again, because the debt just doesn't have to go up every year. And so because of that, there is just this slight increase in cash flows year over year over year. And that's why you kind of see that trajectory. But I mean, again, we're talking the steady state for this company, post-flip, steady state, is not going to happen until 2039. That's 14 years in the future. And so you really have to come back here and say, okay, what discount rate am I willing to put on this thing? Because this company, for the trains that they've already FID, the ones that they FID, that they actually have approved and start construction in 2025, aren't actually going to get to this point until another 14 years into the future. And so, because of that, it's just a long time for investors to wait. And so I think that's, you're not going to see this significant base for the company basically until 2030, maybe even 2032, where people are going to be, I think, narrowing down, okay, this is what we can actually see, line of sight cash flows, what we're going to give it a valuation today based on, what they're actually bringing in. And so because we have to look so far out into the future, that's, I think, why you see so much volatility in this stock. Yeah, and again, none of that is a surprise to people, but I just think maybe when the market, when they finally have this FID, there may have also been a bit of buy the rumor, sell the news, where once they finally hit their FIDs, everybody said, okay, what's the catalyst for the stock in the next 2, 3, 4, 5 years? And on a concrete basis, you might say that there is no catalyst. I do think there are catalysts. I could talk a little bit about the upside, potential factors that aren't in this model, right? Number one, I will call it out. There's a whole bunch of factors not built in this model. I know I've already been talking for a while, so I'll try to be brief here and let y'all go. But I am not assuming anything from the company after 2048. Trains 1 through 5, probably that facility will still exist and still be producing even after 2048. But right now I'm just looking at the time period during which they have these long-term sales and purchase agreements. Another thing is I am not including anything. They talked on the call where they may have some debottlenecking process, basically design improvements and other things that they can put in. I'm not an industry expert. I don't really understand it. But basically they say from trains 1 through 5, the ones that we've already have under construction, that we'll have up in running in the next couple of years. Right now they have a nameplate capacity, but they think with some additional improvements and maybe a little bit of additional equipment, small amounts of investment, they might be able to actually increase the capacity to actually liquefy LNG or liquefy gas and produce LNG. And I don't know how much of how much we could expect from this, but if they got 5%, up to 10% maybe, that would be a significant increase. That might be 10%. Let's say it was 10%, right? If they go from, I'm just going to use round numbers here, from roughly 30 million tons per year to 33 through this debottlenecking process, through some design improvements. And right now I'm glossing over how much it might cost them to actually, in terms of capex, to make this happen. But if they were able to have just a 10% increase in their overall facility, if we look back at sort of their volumes, and we see total contracted versus uncontracted volumes, in their steady state, slightly, I don't know, what is it, maybe 20% of their overall volumes are uncontracted. And so if they increase their overall volume by 10%, and all of that incremental 10% is going to be uncontracted, now they go from 20% to 30% uncontracted volumes. And so that's like a, from 20% to 30%, that's like a 50% increase in their uncontracted volumes, the volumes that they're able to get a much higher margin on. And so that could be material for the company. Again, that is not built in this model at all. There is no specific guidance other than, the CEO saying there may be some upside there, and, we're going to look into it, basically. And he is proactively saying that. This is not something where somebody asked him, hey, do you think there's an opportunity for debottlenecking, and the CEO is trying to give them a, not so negative answer. Like, the CEO is proactively saying this, at least that's my recollection on the call. And, so that is, that I think is something to keep in mind. They may also dilute less than I expect, right? As I mentioned, I am assuming 350 million shares eventually to be outstanding over the next, 5 to 10 years. And maybe they won't get to that point, yeah. Sorry, and so I'm going to pause real quick, talking through some of the upside factors and answer some questions in the chat. Pascal Tuyishime, sorry, I'm sure I mispronounced your name, and I apologize. says, in the next 5 years, would you say that VG is a better investment than Next? So I'm not going to give financial advice, but I'm going to tell you what I personally am doing. And personally, at the current price levels, I am buying NextDecade quite heavily. I am not for Venture Global. Venture Global, I think, is going to do well. I just think NextDecade, like the valuation for NextDecade, has come down well below where I think is a current, fair valuation for the capacity that they already have under construction. I think Venture Global has a lot of additional, upside. It has a lot of additional upside in their future plans. What is it? CP2, CP3, even Delta, and the last valuation model that I did, based on some of the CEO's comments and the progress they've made, I think did give them credit for a fair bit of not yet FID'd capacity. And even based on that, I think the upside in Venture Global, if I give them credit for some of the capacity that they haven't yet FID'd, versus NextDecade, where I'm looking only at the capacity that they have already FID'd, I think there is higher upside in NextDecade than there is in Venture Global at current prices. And again, this could change tomorrow, right? This could change in a week. NextDecade could go up to $8, $9, and then things start to change. Or Venture Global could come down. The market always changes. So, like, my personal, my behavior is going to change based on what the market does as well. And maybe we'll get new information from one or more of these companies. But I think that's how I currently view it. Again, not financial advice. NextDecade, there is still a lot of, there is still a number of risks, and I'll go through those in just a moment. But both companies have risks. Both companies have upside potential. But I personally am investing, I'm adding to Next, and I'm not really adding to Venture Global at the moment. So hopefully that gives you a little bit of insight. Again, I can't really say one thing is a better investment than another just because I don't want to give financial advice. But that's my personal, what I'm personally doing with my portfolio. So what other upside factors could we have? So this model also includes trains 1 through 5, and this sort of, again, tying this kind of like to my Venture Global valuation, I did give Venture Global credit for some facilities that they don't yet have under construction, and some expansions that they don't yet have under construction. NextDecade, they're now starting to call this out. They do have trains 6, 7, and 8 that could bring in additional cash flows after, trains 1 through 5. These are not yet permitted, right? So they're at the very infancy. These are ideas. I guess they're starting the permitting process for, train 6 very soon. Presumably train 7 and 8 would happen, after that, as long as they can line up customers to sign some agreements. As long as they think that's going to happen, they'll start the process, start working with hopefully Bechtel to get those, contracts and EPC contracts in place, right? They get that ball rolling. But again, those are all upside. My model here that says this is what I think the company's currently worth is, or in terms of intrinsic value per share, is not including that at all. They also talk about even trains 9 and 10. That's even additional upside. And one thing that I would call out here is another upside factor for the stock is right now it's discounted at a 13. My model is discounting it at a 13% rate. I think the market is discounting it even higher than that. But one factor that we have here is when they have all these trains up and running, it seems like I'd be a little bit surprised if the market was still discounting it, once all these trains are in a steady state at a 13% rate, right? A lot of risks no longer exist once the plant is actually in operations. If I look at the impact of this today, and I change it from a 13%, if I said, you know what, I'm very, very confident in their construction. I'm very, very confident in a lot of these assumption, so I'm willing to give it a lower discount rate for those future cash flows. And I said, let's give it a 10% discount rate. That's an immediate, as of right now, 40%, higher intrinsic value per share calculation. I do think at some point in 2031, 2032, when the company hits steady state, if not before, the company will get re-rated to a, we call it a higher, multiple, meaning a lower discount rate being applied to those future cash flows because there are just less risks in the company. And so that is another, point to the potential upside. Now I do recall, earlier in the video, much earlier, and so I'm sorry it took this long. There was a question of, what do you think the valuation will be in 5 years from now? So if I look at this in, let's say, 2031, right, beginning of 2031, that's about 5 years from now. We're about the end of 2025. Company will be much closer to a steady state. And so if I look at this, and instead of discounting back all the way to Q4 of 2025, if I discount those cash flows at that point in time to, what will the value be then? And again, and this is actually not even considering the potential cash flows that they'll get between now and that point in time. So the stock would even be higher than this. But if I look at this, and I could do this calculation really quickly, hopefully. Let me see. So for this one, I'm discounting. So I guess I would do my discount rate. Let's see, right here, 13%. This is going to be 1. This is going to be R92 times divided by, well, you know what? Here's what I can do. Sorry, I have a cheat code here. This is going to destroy my model for a moment. So if I made this 1, so this resets all of my, of course. Nope, it's actually this. I need to make this 0, and that should make that 1 and everything over there. So if I do that, and I delete off all of these, my net present value, if I look at only the cash flows starting in 2031, at that point, the value per share will be, the model suggesting intrinsic value per share would be 1669, it says. And again, this is not even giving consideration to the cash flows that you would have received all the way up until 2031, because we do, there might be some value there, but really let's say there's not. At that point in time, you'd expect the stock to be worth, $17 per share. All right, so hopefully that answers your question. I suppose that's a decent way to do it. I would say when you look out at the 2031, we're actually including even less years because, we're only looking from 2031 to 2048. And so you only have 17 years worth there of sort of consideration for the value under their long-term sales and purchase agreements. So there would be slightly undervalue. I would be slightly undervaluing the company even more than what this model is relative to today, because in the future I'm chopping off even more time relative to that later starting point. I hope that made sense. But the punchline there, or the takeaway, is that the valuation, if I do look out to 2031, would be about $16.70 per share, given this model and all of these assumptions. So I did say I mentioned through some of the risks. I'm going to be super brief because I think I'm already over an hour, and this is one of my longest streams ever. Apologize for that. Risks that you have for this company. So don't forget these things. These are important. If you're going to invest, know the risks. And there are more than these. You can look through their 10K, their SE, their quarterly and annual filings. Like, they'll go through a whole bunch of different things here. But the big ones I would call out, you have construction risk, right? Bechtel's pretty good, but they're not perfect. Nobody's perfect. And so things could get messed up. These could be delivered way late, over budget. Bechtel could go out of business. You never know, right? Like, things happen. There are risks there. There could be weather events, right? There could have some major hurricane storm down there on the Gulf Coast and destroy some of the facility as it's partially constructed. That would be real bad for them. We could actually see this LNG glut, right? Right now we're assuming a $5 spread on those uncontracted cargoes. Maybe they only get $2. Like, that could happen. NextDecade is bearing the risk for all those uncontracted volumes. I don't talk about this too much, but I modeled all these as if all the contracts were Henry Hub linked. they do have a small portion, but 1.5 million tons per year from their facilities that are linked to oil prices. And I really don't know exactly how those contracts are structured or work, but that is a sort of a separate risk from all the gas, the Henry Hub link contracts that they have. They could actually have less commissioning cargoes, and so some of these assumptions about how much cash flow they get early on from each train as uncontracted volumes, it could be lower than what I'm projecting. It could be lower than what the company's projecting, and that would be, that would lead to a lower valuation for the company. My assumptions about the hurdle rate that the equity investors need in order to flip from the equity interest to give the additional 2,000 basis points to NextDecade. I could be wrong on that modeling. I could be wrong with a whole bunch of assumptions I have here. Some of these came from the company, but I mean, even their projections or assumptions could be wrong about their operating expenses, their future debt expenses, their G&A expenses, right? All those things are risks. There are some potential supply chain risks, right? They talk about this a little bit in the call, and I think that they're good, but until you have the parts in hand, there's always a risk. My modeling of inflation and some other issues with inflation could end up being wrong, and there are always regulatory risks. If your memory isn't too long, you could see a year ago or 2 years ago, depending on when it was, when NextDecade fell down into the fours in 2023 timeframe. Hopefully I'm getting this right, but this was maybe that's not it. Maybe that's the time frame. I don't remember exactly. I guess it would be this dip here, right? If I remember the sequence of events, they're regulatory issues, and that that's a big deal, and it's always a risk. All right, that was all my material. I'm gonna answer the rest of these chat questions and then hop off because this is a super long stream. I appreciate everybody being here. Looks like there are 13 people on here. That's fantastic. Appreciate you all being here. All right. Pascal says, appreciate your reply. Are you looking into any other companies? Nothing I want to disclose here today. I mean, this is a hard market to be in right now, let's say. A lot of things are very, very inflated. I hate to say, but my most exciting opportunity is NextDecade. That's partially why I prioritize being able to actually get this video out and talk about it, because I personally think this is an opportunity. I'm personally adding to this. There are a couple other companies I add to on a regular basis. None of them are really, hidden gems. They're all things that other people know about. So I don't have anything crazy there. I think NextDecade is a little bit less common of a stock, but that's that's the stock I would say at the current moment that I'm most excited about adding to. But yeah. WW says, do you think AI driving that gas demand could lead to higher prices for LNG companies? Do you see this as a risk for Next business model? That is a risk, right? And I've talked about this in terms of the spread on their uncontracted. So let me give you a nuanced answer here. On their contracted volumes, that's a very low risk, right? On their contracted volumes, sort of that base level cash flow that they're able to get, the way those contracts are structured is NextDecade gets paid based on the, you can go back to whatever slide it is that has their overview of their contracts. But again, other than that 1.5 million tons per year of volumes that they have linked to oil prices, that is part of, I think, Train 1, all the rest of their contracts, to my recollection, are linked to, they're indexed to the Henry Hub natural gas price. And NextDecade doesn't purchase directly at Henry Hub. They purchase, in South Texas, and so, but they believe, and I think history has proven this out as far as they say, that where they purchase it at is even slightly lower than Henry Hub. So there is a slight risk there. Maybe where they purchase at would end up being higher than Henry Hub for some reason. Like, it's possible that they are different. I don't think it's likely based on my understanding and what the company says, but it is a risk. But getting to the point here, their contracts are linked to Henry Hub gas prices, right? So if natural gas prices go up, for all of these contracted volumes, NextDecade will be passing that cost directly along to their customer who is purchasing LNG from them, right? The end cost of the LNG for, in this case, JERA and EQT and ConocoPhillips is the cost of the Henry Hub gas times, the cost of the Henry Hub gas plus 15% of that cost plus the actual fee, the $2.50 per MMBTU or whatever the exact fee is for each contract. And so NextDecade basically gets that $2.50 per MMBTU just in profit. That's their fee for doing the liquefaction. And then there's that additional component that is 15% of Henry Hub. And so for their contracted volumes, which I think for the overall trains 1 through 5 is somewhere around, like 80%. I don't know the exact number off the top of my head. I think it might be on this slide. 85% of trains 1 through 5 capacity is contracted. So for those volumes, NextDecade is going to still make money. So it is not a risk to there. It's a very slight risk, only because they're not purchasing at Henry Hub, right? It's a risk only to the extent that NextDecade's cost of feed gas ends up being higher than Henry Hub, and it has to be materially high, right? If it's like 2% higher, they can probably absorb that within that 15%, 50% of Henry Hub component they have in their sales and purchase agreements. If it, for whatever reason, was double the cost of Henry Hub at their particular location, that would be a major issue for NextDecade. Now, if you flip to their uncontracted volumes, yes, if the corresponding LNG prices, the JKM or the gas prices in Europe, the TTF, if those prices don't go up, then, but the cost of the feed gas, the Henry Hub prices in the United States go up, then that spread will shrink, right? And it's theoretically possible, or I shouldn't say theoretically, it is certainly possible for the Henry Hub price of gas to be higher than what it is internationally, or at least, let's say the price of Henry Hub gas plus the cost of shipping and liquefaction is higher, and so there's actually a $0 or negative spread between those two quantities. And if that's the case, then yes, all these uncontracted volumes, quote unquote, NextDecade would presumably not be producing those. They would not liquefy that amount of LNG. They would only liquefy the amount that's already contracted. And so that is definitely a risk, right? If that happens, then the cash flows to NextDecade would be significantly lower than what we are currently looking at, in terms of the future projections. So that is definitely a risk, but I think that's something that you have to come to peace with as an investor. And I think, if you study I've done that, and I would say if you look at the LNG market, it is generally, and look at the natural gas market, it is generally the case that natural gas, it's easy to think, what, AI drives energy demand, and because there's higher energy demand, there is, that's just going to push up the price of natural gas, a crazy amount, because they can use natural gas to generate electricity for the data centers. And that's only true to the extent that you can transport the natural gas. Natural gas, the whole reason why there is an LNG industry is because you can't just load natural gas onto a ship and then sail it around the world and give it to the country or the customer that wants it halfway around the world. It's not economical. The reason why you liquefy it is because you can get, 300 times or 600 times more gas on the same ship, right, in the same volume, because it takes up 1/300th or 1/600th. I don't remember the exact factor. Somewhere on that order of magnitude, right? It's hundreds of times smaller when you liquefy it. The point is, natural gas, as it exists, is hard to transport. And so the places, it may be the case, and maybe this will happen, but it may be the case that if you're going to have a bunch of AI data centers that are all co-located right around the places where you have natural gas that can be, drilled and extracted, then yes, that could drive up the price of natural gas. It could drive up, frankly, it would just be taking demand, it would be increasing demand, just taking supply right off the market, right? That's what I would guess that's what it would be doing. But again, you do have to kind of figure out how likely is that, and then also if the price of natural gas goes up, how much more is production going to ramp up, right? That's the for a while, that's been the balancing factor in this market. Is it's always been easier to ramp up natural gas production in the United States, to just drill baby drill, right, and get more natural gas extracted in order to serve demand, than it is to actually liquefy it and get it over in the places where they want the LNG. And so for that reason, that's been why there's sort of this structural difference between the cost of the price of LNG at the folks who want LNG, and the cost of the natural gas feed, the feed gas here in the United States, because it's much easier and quicker when prices go up to drill more and extract more natural gas than it is for the folks, you know, who want LNG to find liquefaction capacity and LNG shipping capacity and regasification, right? And so, or for them when they're looking at other alternative methods of, you know, energy, you know, they don't have, some of those places don't have a lot of great options, and LNG is their, you know, you would say their least worst option, and so that's a reason why their demand has remained high. So that's kind of the way that I see the market. Hopefully that gives you some insight, and hopefully that helps. I think it is a risk, right? I don't want to say that it's not a risk. So because to answer your direct question, do I see it as a risk for next business model? Yes, there are tons of risks. You have to come to peace with it and say, how likely is this risk? And, you know, I put that in the low risk category, at least for now. That's how I see it. Again, could be wrong. It is a risk, and so when I say it is a low risk, that is a thing that I don't think is particularly likely, but could happen. And again, I'm trying not to say too much, because, you know, if you've seen from some of my prior videos, I mentioned before, I do work at a company, and I work very much in the data center division, and so I have some inside information on data centers. I want to be clear, my answer is in no way, shape, or form based on any information that I have there, but just in general, looking at the energy industry and the LNG industry, that's kind of how I see things. So, all right. And WW says, great answer. Thank you. You are absolutely welcome. Great question. All right. It has been a long time. I appreciate everybody who came and watched. Hopefully you enjoyed the video, but I am going to hop off now. Thank you very much for watching, everyone. And hopefully I can get to do some more videos in the not so distant future. My life is just super busy. I have 4 kids, and I recently became a manager at my job, so it's kind of hard to find time to do YouTube. But I will do my best in the future. I really appreciate everyone's support and everybody who's watching. Thank you very much, and have a